For this session, we will talk about your introduction on financial management or your FinMan preliminaries. So for FinMan preliminaries, we will discuss, of course, the definition of financial management and what is the purpose of at least of learning financial management and what are the careers in financial management, particularly in managerial finance. But before we formally start with our introduction, let's take a quick look on what could you expect in financial management. So AE 108 or financial management, we will learn about your financing generally. But in talking about your financing, of course, we go back to your rule on your basic accounting equation. As you all know, your basic accounting equation is equal to your asset is equal to your liabilities plus equity. And if we try to interpret that accounting equation, you know that it means that your assets are financed by either your liabilities or your equity. Furthermore, this particular accounting equation could also be deduced as asset is equal to equity. Why is it asset is equal to equity? Asset is equal equity because asset is the equity of your creditors, which now represents your liability, and asset is the equity of your investors or your owners, which represents your owner's equity. So by now, you should learn and you should know that your asset, your asset is financed by your liabilities and equity. So since your asset is financed by your liabilities and equity, in financial management, we learn how to properly finance your asset. So we will learn financing decisions as to your financial management. So when we talk about your financing decisions, you learn that since asset is financed by liabilities and equity, we learn that your asset may come from liability or equity. And when we talk about liability, that can either be a short-term liability or a long-term liability. And when we talk about equity, that is your shareholders' equity. Now, if we are to discuss your financing decisions regarding your asset, what we look into in your financial management is your short-term financing. If ever your finance of asset comes from short-term liability, or you know this one as current liability, but if your finance comes from your long-term liability and your equity, we call that your long-term financing. So we will talk in this subject about your short-term financing and long-term financing and what to expect. How do we finance your assets as to the usage of your current liability, non-current liability, and your shareholders' equity or your equity. Now, after knowing how to finance your assets, of course, we should also learn the proper mixture of your financing. So, do we want more equity as a finance of on our assets, or do we want more liability as to the financing of our assets? We call that mixture as your capital structure. So as we go through our subject, we will also talk about your capital structure. And when we say capital structure again, it is the proper mixture of your assets. Is it from purely liability or purely equity? And as we go through your capital structure, we will learn about your leverage. So when we say leverage, generally we are focused into your financial leverage. So when we say financial leverage, how much of our assets is financed by your liability? So we can look into how much liabilities is used to finance our assets. But when we talk about your capital structure, what is the ratio of your liability and equity as to the finance of your assets? And as we go through this financing, short term and long term financing, we will talk also about your cost of capital. So, what is cost of capital? Remember, we said a while back your capital structure is the proper mixture of your liability and equity. And when we talk about your capital, we talk about equity here, which is composed of either your liability or equity. So, in short, in finance, when we talk about your capital, it can come from your liability or equity. Now, upon knowing the proper mixture or proper capital structure of your finances, we take a look into the cost of your capital structure. So the cost of your capital structure is known as your cost of capital. So when we talk about your cost of capital, always remember that there is nothing in this world as a free lunch. Nothing is free. Therefore, if we finance through a liability or through an equity, of course, it bears a cost because that finance is not free. So when we talk about your cost of capital, we talk about your cost of that liability, which finance your asset, or the cost of your equity, which finance your asset. So what is the cost of this liability and the cost of your equity? The cost of your liability is known as your interest, and the cost of your equity is known as your dividends. So in your cost of capital, we will determine the cost of your liability and equity. We will learn the cost of the long-term debt, the cost of your common stock, the cost of your preferred stock, or your cost of equity. Furthermore, we will express it in a particular percentage. So normally, when we talk about your cost of capital, it is expressed in a percentage. And if you will multiply it to the weight, sir, what is this particular weight? That weight is known as the capital structure. As you remember, that is the proper mixture of your financing. If you multiply the percentage or the cost to the weight, you will get for the weighted average cost of capital. So we will discuss all of this from cost of capital to weighted average cost of capital. Finally, when we are here in your cost of capital, especially dividends, we will also talk about your different dividend policies. So how do we pay off your equity or your shareholders? Okay, so that revolves around purely financing decisions. Now, if we want to look into your investment decisions, if we look into your investment decisions, therefore, we are now looking into the utilization of your finance through your assets. So the utilization of your finances now. So how will you invest the finance that you have already raised for the company? So you can invest it to either short-term assets or your long-term assets. So when we go to your short-term assets, we will discuss your working capital management so that we can properly manage our short-term assets. And then for long-term assets, you will go with your long-term decision making. However, long-term decision making is not part of AE 108. What I want to point out here is so long you have already your finances, you can make investment decisions. Aside from financing decisions and investment decisions, we will also talk about your dividend decisions. And when we say dividend decisions, what is the topic on that dividend decision? We have your dividend policies. And finally, we will also talk about your risk management. Why? Because as a financial manager, we are very prone to risk. There are too many financial risks on a corporation. So those financial risks must be properly managed through effective risk management. And what is our effective risk management? That is your derivatives. So these are all the topics that we will learn in this subject. We go with your working capital management for your investment decisions. We go to your financing decisions from short-term financing, long-term financing, capital structure, leverage, and your dividend policies. Towards risk management, for your derivatives and your dividend decisions for your dividend policies. So these are all of our topics in financial management or AE1. Having now a brief background or having now an idea on what is financial management, we can now proceed on defining what is finance and what is financial management. Let's start first with the definition of finance. So, what is the definition of finance? Finance is the science and art of managing money. As you can see with our introduction a while back, finance or financial management generally start with your financing or your finances. And how do we properly utilize that finances? Okay. So as you can see a while back, when we talk about financial management, we are talking about the finance that we have raised. So through your financing decisions and how we will manage that finances by properly utilizing those finances. Now, let's go to the definition of a financial management. So, what is financial management? The financial management is the management of the finances of an organization in order to achieve the financial objectives of the organization. Okay, so take note, as a financial manager, what we need to do is to properly manage the different finances, and these finances be used to reach the financial objectives of the company. Now, what do we mean by objective itself? What do we mean by objective itself? So when we talk about objective or corporate objective, these are different objectives that are relevant to the organization as a whole, which relates now to the key factors for the business success. But actually, as a financial manager, our main objective is the maximization of your shareholders' wealth. Again, as a financial manager, what we normally look into or what we normally want to meet is the maximization of your shareholders' wealth. Why do we need to maximize your shareholders' wealth? Because this is like a twofold function in between your investors and as to the corporation. If you still remember, your equity will fund your assets. As a way to give back, you must increase that equity or you must give back to that equity. In giving back, we don't only look into your dividends. We look into your increase in share prices. So we look if ever the share price during the investment, let's say you invested before, the share price is 30 pesos, and now because of properly managing the finances of the corporation, you have now a share price of 35. So that could increase the shareholders' wealth. Aside from that, we also look into our market strength. So when we look into your market strength, what we dwell into this is your different basic earnings per share or the value of your shares. So generally, as a signal to your shareholders' wealth, we look into the increases or decreases in the shares. The increases or decreases in the shares. So as of now, you already know that if we talk about financial management, the main objective is to increase the shareholders' wealth. And what are those targets that we normally look into? These are your earnings, this is the value per share, these are the dividends, these are the increase in your share prices. So if we discuss what are these types of objectives, we go back to it. These are your financial objectives. These are your financial objectives. Okay? Just take note that the usual assumption in financial management is that the primary financial objective is the maximization of shareholders' wealth. If you go back and you ask, how can we know that the shareholders' wealth were properly maximized? So, what are those targets? Again, it can be increase in share prices, earnings, earnings per share, value per share, dividend per share. Okay? So those are financial targets or financial objectives that could lead to the maximization of your shareholders' wealth. Sir, question. We've been emphasizing about shareholders' wealth. How about stakeholders? The question is, what is or who is a stakeholder? So when we talk about your stakeholders, this is any person who in any other way connected with the organization. So anyone who has a transaction with the organization can be considered as a stakeholder. Therefore, your employees, your suppliers, the government, they can be considered stakeholders. They come uh, they come second to your shareholders. What is important? The financial objective that the shareholders' wealth will be properly maximized. Shareholders' wealth will be properly maximized. Okay, so take note of this, the maximization of your shareholders' wealth rather than maximization of your stakeholders. Okay, so let's proceed. So when we said maximization of your shareholders' wealth, we discussed about your financial targets or financial objectives. And if you remember, we are more inclined into increase in share prices, earnings per share, dividends per share. And we did not talk about profitability. Okay, now we look why profitability or profit maximization is not good for maximization of your shareholders' value. Okay, so profit maximization may not lead to the highest share price for at least three reasons. So as you can see, we have here the term share price, which we have already used a while back when we discussed about your maximization of shareholders' wealth. Okay, so the following are the three reasons. The first reason is that timing is important. The receipt of funds sooner rather than later is preferred. Why is this placed here? Because guys, you know that profit is presented using accrual basis. So profit is presented using accrual basis. So when we say profit is presented using accrual basis, it means that your profit as reported in your financial statements does not show the total collections on your income, but rather it shows the total earnings. So the total of what is earned. And remember when we say earned rather than collected, when we talk about accrual basis. And for finance, what is important again? In finance, what is important is the finances. When we talk about finances, we talk about money. And if you are more of profit maximization, meaning the earned rather than the collected, then you have a problem on increasing the shareholders' wealth. Why? Because the twofold function of a maximization of your shareholders' wealth does not only end with the dividend declaration uh, to your shareholders. But also, when we talk about your shareholders' wealth maximization, is that the finances that you have raised from your shareholders are properly utilized in the operation of the business. If ever the finances is tied up on your accounts receivable, if your finances is tied up on your accounts receivable, of course, you cannot operate effectively and efficiently. Why? How does profit maximization works or how does your profit happens? Remember in your profit, once you have finances, which could help you in the production process. So first, you need to raise finances. Now you need to produce, and then finally you need to sell. In selling, generally you sell through credit, therefore you have AR, and eventually you could collect that. Now your finances, if purely it is stuck here in your AR and it did not become cash, to at least reinvest it on our production again, then you have a problem. Okay? That's why timing is important as to your profit maximization. That's why also it is not a good means to maximize the wealth of the shareholders. Another reason, profits do not necessarily result in cash flows available to stockholders. Okay, as we have discussed a while back, your profits normally can be tied up to your AR. And what is one signal so that we have maximized the wealth of the shareholders? To maximize the wealth of your shareholders or stockholders, we give dividends. Okay, so if it's tied up to your AR, it means you have no cash to provide as a dividend. You already know that one of the most common dividend given to your shareholders or stockholders is a cash dividend. Therefore, guys, if it's tied up to AR and it is not converted into cash, then again, it will not signal that your wealth or the wealth of the shareholder is properly maximized. And lastly, profit maximization fails to account for risk. What is this risk? The risk of uncollectability of your receivables tied up on your profit. So it fails to account for the risk. What we look into in case we have a receivable is that we feel that we can collect it, but actually there's a problem with that because there's also a risk that you might not collect it. There is a chance that you might not. Therefore, what's the best still target to give your shareholders wealth maximization? We go back to the different financial targets rather than profitability. We go now into your career opportunities in finance. So we have already finished the introduction to your financial management. So how does financial management works and what do you expect on your financial management and what is the purpose or objective of your financial management? Always remember the main objective of financial management is to maximize the wealth of the shareholders. We go now to your career opportunities. During the introduction, I told you that when we talk about your career opportunities, we mainly focus ourselves into the career opportunities in managerial finance because generally financial management is practiced in your managerial finance. So let's start first by knowing the two categories of your opportunities in finance or categories in finance. So your finance can be broken down into two main categories. And that is first your financial services, and then second, that is your managerial finance. Bulk of our topic will come mainly from managerial finance rather than financial services. But before we go and look into the career opportunities in these two areas or broad categories, we first define what is financial services and what is managerial finance. So first, financial services. Financial services is the area of finance concerned with the design and delivery of advice and financial products to individuals, businesses, and governments. As you can see, financial services is more personal. When we say it is more personal, it is more of what is better for a particular individual. When we talk about individual, that can either be juridical or it is a natural individual. So you look into advices and financial products that is applicable to your individuals. If you think of a financial service that gives advice and financial products, what particular market do you have in mind? Perhaps you have in mind your different insurance because insurance is more personal. To at least safe keep your personal finance, you can have an insurance. So this is tailored fit to a particular individual or a business or a government. So you could give advice and a product of insurance to these types of individuals. Next, growth category of finance is your managerial finance. I told you our focus will be with this. So managerial finance is more concerned as to the financial manager working in a business. So now we are managing the finances of the business. So how do we again manage the finances of the business? As we have said a while back in our introduction, we make four decisions in financial management. So what are those decisions again? If we go back to our previous lecture, the first decision is your financing decision. So we look for a proper source of finance. Then we also have your investment decision. We also have your dividend decision. And lastly, we have your risk management. Okay, so these four items come hand in hand in the management of the finances of the business. Take note, financial services is more personal, while managerial finance is the topic that we need to focus on because this is how we will manage the finances of a particular business. Okay, so as you look into this second definition, financial managers administer the financial affairs of all types of business. Financial affairs of all types of business. So when we talk about financial affairs, we talk about these items or different financial management decisions. We go now to the specific career opportunities in financial services. So again, we have two broad categories, financial services and managerial finance. So let's start first with financial services and what are the different career opportunities. First, banking. So you can work in a bank to give advice. Also, personal financial planning. Again, this is personal. Investments. Again, another personal. Real estate, whether you will purchase a real estate or not, another personal decision. And lastly, insurance. We gave a while back insurance as an example of your financial services. Let's go now and proceed to the career opportunities in managerial finance. So, what are the career opportunities in managerial finance? So as you all know, managerial finance is one of the two broad categories of finance. So if you are into financial management, then what can be the possible opportunities for you? The first one here is a financial analyst. So in financial analyst, you prepare financial plans and budgets. And of course, you also analyze those plans and budgets. Normally, in making plans or budgets, you first have a prior financial statement and you analyze this financial statement or prior financial statement, let's see 2020, to make plan or budgets for 2021. So mainly, what does your financial analyst do? It analyzes previous year's transaction or previous year's finances and create a plan or budget based on those previous year's finances. So the other duties, of course, will include forecasting because again, based on those previous year, you try to forecast your plans and your budgets. Again, you also compare from year to year to create your plans and budgets. And of course, you work closely with accounting. Why? Because the financial statement comes from your accounting department. Another career opportunity in finance is a capital expenditure manager. When we talk about capital expenditure, what comes into your mind should have been long-term investments. So when you hear capital expenditure, this is more of long-term. When you hear revenue expenditure, this is more of your short-term. So what we have here as a career is a capital expenditure manager. And what is the work of a capital expenditure manager again? It evaluates and recommends proposed long-term investments. Once there is an evaluation and recommendation of your proposed long-term investments, we need to have your project finance manager. So this project finance manager is responsible in the financing of the approved long-term investments. So as you can see, long-term investments is given by your capital expenditure, and now it will be approved, and then it is subject to financing. Your long-term investments is known as your investment decision. So again, you need to finance that decision. or your investment decision through a financing decision. Another career opportunity in managerial finance is cash manager. Of course, you maintain and control your cash balances. Furthermore, another career opportunity in managerial finance is your credit analyst and manager. Why is this important? We have discussed a while back that possibly your money can be tied up into your accounts receivable. Therefore, the best way to tie up that particular money in accounts receivable is to properly analyze the credit of that particular person so that we could easily collect. Okay? So we look now into the collectability of a particular receivable by, of course, analyzing a particular debtor, whether or not we should provide on that particular debtor or we should not provide on that debtor. So here, credit analyst or manager, you look into the credit policy, you evaluate your credit applications, as we said a while back. You look whether you need to extend on that particular person or not, you extend credit, and of course, you monitor and collect AR. So the main function of your credit analyst or manager revolves around your AR. So not to tie up your money with your receivables. Then we also have your pension fund manager, who is responsible for your employees' pension fund. And lastly, we have your foreign exchange manager, who now manages foreign operations and exposure in exchange rates. Okay? So again, two main categories, managerial finance and financial services. Main focus, managerial finance. Since we have been talking a while back of financial management and we have already mentioned a financial manager, let's define who is a financial manager. So, financial manager is the person who administers the financial affairs of all types of businesses. You already know that one. So, to manage the finances of the business, we call that financial management. The person who manages the finances of the business is known as your financial manager. So, what are the tasks of your financial manager? Your financial manager develops a financial plan or budget, which we already know that one as a work of your financial analyst. You extend credit to customers, credit manager or analyst, evaluating proposed large expenditures for their financing. We have your project expenditure or project manager, raising money to fund the firm's operation. That is again your project manager. But actually, in your evaluating proposed large expenditures, this can be for your capital expenditure manager. So as you can see, the financial manager is like the boss of your other managerial finance career opportunities or positions. So they are under the head, which is known as your financial manager. And last topic for our introduction, we need to define and differentiate a financial manager to your accountant. Okay, so basing from your different career opportunities a while back in financial management, by now you have an idea of what is the work of a financial manager. And we have already discussed this also in the previous slide. So financial managers evaluate accounting statements, develop data, and make decisions based on the assessment of the returns and risks on that financial statement. However, accountants is more of the collection and presentation of financial data. So accountants only create your financial statements, so they only prepare your financial statements, while your financial manager will evaluate and also analyze those financial statements to make financing decision, investment decision, dividend decision, and lastly, risk management decision. That's it for our introduction on financial management.